speaking with Morgan's chief economist, Michael Knox. Michael, thanks for your time.
Happy to talk, Tom.
I'd like to ask you about two macro threats to markets this year in US inflation and the outlook for rates, and trade, which is making a lot of headlines. Firstly, on inflation in the US, we saw that better than expected wages in early February triggered somewhat of a market response, and since then we've down about 10 or 8% in the US market since then. What's your outlook for the inflation environment in the US and its implications on rates?
Well, the Fed knows a lot more about US inflation than I do, and they think that core inflation this year will be only 1.9%, which is still below their 2% target. And next year it'll rise to 2.1%, which is just over their target. And up until now, they thought inflation next year would be 2%, and they've increased it above that to 2.1. Why that's really interesting is that they've significantly increased their growth estimate for this year and next year. And they've also significantly reduced their level of unemployment that they estimate that the labour force will get down to. So growth this year is estimated at 2.7%, which is about 30 basis points higher than they previously thought. And next year it's 2.4%, which is also higher than they previously thought. So normally when you had higher growth like that, you'd have a surge in inflation. And the other thing which would suggest there'd be a surge in inflation was lower unemployment, because normally that would generate higher wages growth and that would generate higher inflation. But really they've only forecasting next year that inflation will go from their forecasted 2 to 2.1. The question is why? And it seems that the Fed believes there is a supply side response from the tax cuts. So because corporate tax cuts, because of corporate tax cuts, there's less company tax paid. Therefore, companies have more retained earnings to invest. With more investment, there's higher capital per worker. Capital labour ratio goes up. And that's how productivity rises. So there's an increase in productivity in the US economy over the next 2 years. And the other thing that happens in the tax cut legislation is that there was cut to personal income taxes. So more people will come forward to fill the jobs at the same wage rate. So that gives you a lower sustainable unemployment level and a higher potential growth rate. And those are like really good results of the tax cut legislation. So we've got a better performance for the US economy delivered by tax cuts, and really a very, very moderate outlook for US inflation. We've said before that we think that will be 4 rate rises in the US this year, and that's still our view. And that's the reason that there's 4 rate hikes this year in the US is because the US economy is growing so strong.
The second issue that's been spooking investors has been a notional trade war, as the press would have us believe, between the US and China. Just how real is this situation, and is market weakness a risk or an opportunity for investors?
Well, we've been saying for weeks really that what's happening is not a trade war but the beginning of a trade negotiation. We read a piece and we looked at the relative levels of import tariffs within the World Trade Organization guidelines that are provided by the United States for import of products into the US, both for agricultural products and for manufactured products, and we compared that to China. And what we found was that the import tariffs that the United States is charging on imports to the United States is around about half that China charges for imports into China. And so what we think is actually happening is that President Trump is attempting to negotiate down the Chinese import tariffs for American goods. Now, there was talk about hiking tariffs on both sides, and that was entirely misinterpreted by the media as being the beginning of a trade war. Not at all, just the beginning of a talk to focus issues on international trade. And now President Xi in the last week has talked about cutting import tariffs for motor vehicles, and that would be really important if China cut its import tariffs for motor vehicles, because of exports of American cars would firstly generate employment for American car workers, but also that would generate an increase in the demand for steel, American steel in the United States. So it generates more jobs for American car workers and more jobs for American steel workers. And that's the kind of thing that Trump is trying to achieve for his supporter base, hopefully by the time of the midterm elections.
So if we've got market weakness, yet good US growth, moderate inflation and no trade war, sounds like a market weakness is an opportunity rather than a risk for investors.
Yeah, sure. So we think that fair value in our market, the ASX 200 is around 6,200 and change at the moment. So the market is a few hundred points too cheap. And so we think that, this is an opportunity. But the other things that are happening too are that commodity prices are looking pretty good, and that supports the Australian market too. So we think it'll be a much more positive outlook for the Australian equities market than is currently the case.
Sure. Terrific to chat, and thanks for your time.
Thank you, Tom.